Good day everyone, thank you for joining me. My name is Matt and I'm the IT and Comms Analyst, and I'm going to discuss our latest report on Alphabet, which covers the first quarter results for 2021. In this presentation, I'll briefly discuss the results, which were very good and beat expectations. I'll go through our valuation of Google and discuss why we're changing our call to underweight. Essentially, there are far more negative catalysts than positive, these being a higher interest rate environment, a tighter regulatory environment, and a higher tax environment. And with the significant outperformance to peers year to date and trading at all-time highs, we think the risk-reward profile is now skewed to the downside. Looking at the results, revenue increased 34% to 55 billion. Ad revenue was up 32%, YouTube ad revenue was up 49%, and cloud revenue was up 46%. Income from operations doubled, and there was a $5.1 billion increase in other income, which was driven by unrealized gains in Alphabet's non-marketable securities. This had a positive impact on net income and earnings per share, which were up 162% and 166% respectively. The results were received well by the market. The revenue beat was $3 billion, which is a big number, and shares hit all-time highs. Under my coverage at PSG Wealth, Alphabet is the best year-to-date performer with returns of over 44%. Second to them is Facebook, which is up about 20%, and the rest are in the single digits, either positive or negative. Since our last report, it has outperformed the benchmark by 40%, and since the start of the year, earnings have been revised upwards by 42% and 31% for the next 2 years respectively. In the assessment, we agree that the results are very good, but that once-off item of $5.1 billion is going to be difficult to repeat. And despite Google being a fantastic, high-quality company, our valuation has led us to the conclusion that Google's return profile is asymmetrical. We've done a valuation in two parts. One is the sum of the parts valuation, and the second is a reverse DCF where we stress test the interest rates. So our sum of the parts multiples based valuation gives us a target price that is more or less in line with the current market price. However, when we do our reverse DCF and we stress test the interest rates in a higher tax environment, the return profile gets tipped from marginal upside to large downside potential. And given Alphabet's recent performance, we're downgrading our recommendation from neutral to underweight. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, the report on Alphabet can be found on MyBase. Thanks for tuning in. Before we end off, please take note of the following disclaimer. Thank you.